Hey everyone, welcome back to the channel. Today, we're diving into one of the most exciting and controversial names in the online sports betting space, DraftKings, ticker symbol DKNG. Whether you're a believer in the rise of mobile gambling or skeptical about these high-growth, money-burning tech plays, this video is for you. We're going to break down everything you need to know about DraftKings from a long-term investment perspective. And by the end, you'll have a clear view on whether it deserves a spot in your portfolio. Let's get right into it. Let's start with the basics. What is DraftKings and how do they make money? At its core, DraftKings is a digital sports entertainment and gaming company. The business has three main segments: online sports betting, iGaming, and daily fantasy sports. They operate in the US, which is going through a massive shift. After the Supreme Court struck down the federal ban on sports betting in 2018, states have been legalizing at their own pace. And that has created a gold rush for operators like DraftKings. Their bread and butter is their sportsbook, the mobile app where users can bet on everything from NFL spreads to live NBA props, all in real time. Then there's iGaming, or online casino games. Think digital blackjack, slots, roulette. That's available in fewer states, but has even higher margins than sports betting. And finally, the daily fantasy side, which was how DraftKings got started. It's a smaller part of revenue now, but it remains a core part of their user funnel. People enter contests, win prizes, and then often get cross-sold into sports betting once it becomes legal in their state. Now, let's talk about the opportunity, because the addressable market here is huge. Right now, only about 40% of the US population lives in states where mobile sports betting is legal and operational. That number is expected to grow over the next few years as more states pass legislation. According to DraftKings' own investor materials, the total addressable market across sports betting and iGaming in North America could exceed $30 billion annually. That's not even counting potential expansion into other verticals like media, international markets, or even partnerships with leagues. So the top-line growth potential is massive. But of course, we've seen plenty of companies with huge TAMs that still fail to turn a profit. So let's dig into the financials. As of 2024, DraftKings is bringing in over $4 billion in annual revenue and growing that top line at around 40% year over year. That's seriously impressive. A lot of that growth is driven by new state launches. When a state like Ohio or Massachusetts goes live, revenue jumps immediately due to a flood of customer signups and promo activity. But here's the catch. DraftKings is still unprofitable. The company has been burning hundreds of millions per year on customer acquisition, product development, and promotional credits. However, the picture is starting to change. In their most recent quarterly report, DraftKings actually posted positive adjusted EBITDA. That's a big milestone. It means the core business is inching toward profitability. Management has also guided for positive EBITDA for full year 2025, which could be a turning point. So while they're still losing money on a GAAP basis, the losses are narrowing, and the company is showing signs of financial maturity. Next, let's look at unit economics. Because when you're analyzing a growth company like this, you have to ask, is each customer actually profitable? And the answer increasingly is yes. In their more mature markets, states where they've been live for more than 2 years, DraftKings reports contribution margins over 50%. That means once they acquire a user and promotional spend levels off, those users generate solid profit. Customer lifetime value in those states is high, and churn is relatively low for such a competitive space. The big expense comes from acquisition in new markets. When a state goes live, DraftKings spends a ton on marketing, ads, bonuses, promos, to get users in the door. But as that spend normalizes and users stick around, the company starts to recoup that investment. Now, a lot of people are asking, how sustainable is this model? What happens when promo money runs dry or users get bonus fatigue? That's where product differentiation and brand strength come in. DraftKings has one of the most recognizable brands in the space. They're also building out proprietary technology, live betting features, same-game parlays, and integrations with sports leagues and media partners. All of this helps deepen engagement and reduce churn. They're also investing in personalization, offering bet suggestions based on user behavior, targeting notifications, and adding more gamified elements to the app. That could help them retain users even as competition ramps up. Now let's talk about the competition, because this is a crowded space. You've got FanDuel, owned by Flutter Entertainment, arguably DraftKings' biggest rival in the US market. FanDuel has been beating DraftKings on market share in several states and has posted stronger profitability so far. Then there's BetMGM, Caesars, Barstool, Fanatics, and more recently, ESPN Bet backed by Penn Entertainment. The barriers to entry in terms of launching an app are low, but the barriers to scale are huge. That's where DraftKings' first mover advantage and brand equity help. So while the competition is fierce, the winners are starting to separate from the pack. Most analysts agree the top 2-3 players will dominate the market long term, and DraftKings is very likely one of them. Let's now shift to the balance sheet and capital structure. DraftKings has over $1.5 billion in cash on hand and has been managing its burn more responsibly in recent quarters. They've also restructured some of their debt to extend maturities and reduce interest expenses. So while they're still technically in a high-risk category due to cash burn, they're not in immediate danger of a liquidity crisis. Also worth noting, they haven't diluted shareholders as aggressively as some other growth stocks. They've issued shares, yes, but it hasn't been catastrophic, and now that they're moving toward profitability, dilution may slow down. Now let's take a look at the stock itself. DraftKings went public via SPAC in 20, soared to over $70 a share during the 2021 boom, then crashed down to the teens during the 2022 growth sell-off. Since then, it's rebounded significantly and is now trading in the mid to high 30s, depending on the day. Valuation is tricky here. The company is not profitable on a net income basis, so you can't use traditional PE ratios. Most analysts look at price to sales, which is currently around 7x forward sales. That's not cheap, but it's reasonable for a company growing revenue at 40% plus with improving margins. If you believe in the long-term story, that DraftKings will be one of the few dominant players in a legalized high-margin market, that valuation could make sense. But if you're risk-averse or looking for near-term cash flow, this probably isn't the stock for you. So what about risks? There are quite a few. First, regulatory risk. Sports betting is still a patchwork of state laws. Federal regulation could change the landscape for better or worse. And international expansion brings a whole new set of regulatory challenges. Second, competitive risk. If ESPN Bet or another player starts offering better odds, more bonuses, or just a better user experience, DraftKings could lose market share. The moat here is real but not impenetrable. Third, economic sensitivity. Gambling tends to be cyclical. In a recession, people bet less. Or if inflation eats into disposable income, users may tighten up on spending, and promo hunters might be harder to convert into loyal customers. Fourth, stock-based compensation and dilution. While it's under control now, it could creep back up if growth slows and the company uses more equity to retain talent. And finally, technology and cybersecurity. With so much personal and financial data flowing through the platform, any breach or prolonged outage could damage the brand and lead to lawsuits. But with all that said, let's wrap it up with the big question. Is DraftKings a buy right now? Here's my honest take. If you're a long-term investor with a moderate to high risk tolerance and you believe in the legalization trend, mobile-first behavior, and the idea that DraftKings will be one of the final few winners, then yes, DraftKings could be a compelling growth opportunity. You're getting a company that is growing fast, improving its margins, showing signs of profitability, and building a recognizable consumer brand in one of the fastest growing segments in digital entertainment. However, don't expect a smooth ride. The stock is volatile. It will react sharply to earnings, regulation news, and competitor activity. You have to be okay with seeing double-digit swings and temporary drawdowns. This is not a utility stock. It's not even a mature tech stock. This is a speculative growth play with the potential to become a much bigger company, or flame out if execution falters. So if you want exposure, I recommend starting with a small position. Dollar cost average if you're confident in the story, and be ready to reassess every few quarters as the company matures and as the market evolves. Personally, I think DraftKings is one of the better positioned companies in this space, and I'll be watching closely, especially around profitability milestones and new market entries. And that's going to do it for today's deep dive on DraftKings. If you enjoyed this long-form breakdown and want more stock analyses like this, make sure to like the video, subscribe to the channel, and hit that bell so you don't miss what's next. What do you think? Are you bullish or bearish on DraftKings? Do you own it? Avoiding it? Let me know in the comments. I love hearing your perspectives. Thanks for watching, and I'll see you in the next one.